TransDigm is basically a conglomerate of 100 small monopolies. They buy companies that dominate a specific niche, leverage their pricing power, and then scale it up. They've done that for over 3 decades now, and they compounded at a ridiculous 30% per year.
They've seen quite some pushback throughout the years, though, for flexing their pricing power. Maybe just a bit too much. They have these products that they sell for margins of more than 1,000% in some cases.
Even more impressive that despite the outside pressure, no competitor could take market share or even start to compete with TransDigm. Today, we will figure out why and whether TransDigm can keep compounding at 30% per year.
I'm not sure exactly how Daniel found the company for today's pitch, but I like the idea of imagining that on one of our last flights to some TIP event or maybe the conference we both attended together in Lisbon recently, that's where the idea came from. And I say that because the company we're covering today is TransDigm. And it's not a company that a lot of people outside of the investment world are probably familiar with, but if you've ever buckled a seatbelt, opened a cabin door on a plane, or just heard the hum of an aircraft engine, then chances are you have interacted with directly or indirectly with a part made by TransDigm. And investors should probably know the company because it has been this just tremendous performer in the last 20 years, averaging almost 30% compound annual growth rates since its IPO in 2006. So Daniel, I've got to ask, was it when you were looking at your seatbelt on our flight back from the TIP summit in Big Sky, Montana, that you thought, hey, what company produces this? Or where did the idea come from?
Well, I wish I could say that my curiosity is strong enough so that the first thing I do on a plane is check which company manufactured the seatbelt. But unfortunately, I'm not quite there yet. So, I get pretty interested in a company when I see a stock compounded as TransDigm has. And at the same time, this might be the first year since 2008 that TransDigm stock could close negative year over year. Every single other year, the stock only knew one way, and that way was up. So today, the stock is flat year to date after nosediving 20% in August, and I think that makes for a pretty good case to pitch it today.
What's pretty interesting as well is that this company is in the aerospace business, evidently, and it's an open secret that airlines, for example, are a terrible business model. There's a stat that goes around that historically the airlines have destroyed more shareholder value since their inception than they've ever created. But apparently that's not quite the same for companies that are operating in the background, behind the scenes, enabling these airline businesses. And for anyone wondering why we're talking about seatbelts and cabin doors at the beginning of today's episode, that's because TransDigm manufactures equipment to be used on airplanes, including seatbelts and cabin doors.
Well, the interesting thing about these products and the business as a whole is that even the products that are relatively easy to build have extremely high barriers to entry. When you design an airplane, the parts included in that design have to be on the plane later on. So you cannot change even the smallest thing about it, not even the seatbelts or the cabin doors. So once your product has secured a spot on an aircraft, you basically own that part of the plane for decades because only your product is certified for use. So when the seatbelts have to be replaced, it has to be you that supplies those new seatbelts. And airplanes are in the sky for about 30 to 50 years on average. So you can already imagine the aftermarket is where things get really interesting for businesses like TransDigm. And the aftermarket is essentially the secondary market for parts and services used to maintain, repair, or even upgrade an aircraft after the initial sale.
And that dynamic is why TransDigm really has this quasi-monopoly, you might say. One of its main strategies has been to expand that monopoly position with M&A, acquiring as many other kind of tangential products in the aerospace ecosystem as possible. So how about you tell us about TransDigm's history and their philosophy so that we can better understand exactly how they've used M&A to get to where they are today, what they look for in the companies they acquire, and really what their hurdle rate is for determining whether an acquisition is worthwhile to undergo. I mean, seemingly they have to be very selective for them to be able to achieve these 30% returns over 2 decades as something of a programmatic acquirer.
Oh, they are. They definitely are. I mean, TransDigm was founded in the early 90s by Nick Howley and Doug Peacock, and Both of them were former McKinsey consultants, which is funny because I'm usually skeptical when consultants take over companies. I have no data to back it up, but it often feels like that's a turning point for the worse for the company that they take over. This time, though, they founded a company instead of taking one over, and the idea has basically been to take a private equity approach to aerospace. So a lot of the big manufacturers in the space play the volume and the pricing game, which features huge factories and very thin margins. And that's not what the two of them wanted for TransDigm. So they focused on buying small but highly profitable niche businesses. So basically companies that dominate a specific component of an aircraft and then running them with the discipline of a PE fund.
It's so typical for consultants or MBAs to focus more on kind of the economics of business than say on maybe really the long-term innovation of the product. And in part, that's because they rarely have enough technical insight that I think could be of value. So they just kind of blindly push cost cuts or price increases that look good for the short-term business, but maybe come at the expense of the longer-term strategy for success.
And that's usually where it doesn't work out that well when they take over a company. However, in this case, they were well aware of their shortcomings, and that's why they've set up TransDigm in a way that they don't really need that much technical expertise. They only bought companies that were already producing certified products with basically no real alternative supplier. And then once the company was acquired, it was left to operate independently, and TransDigm only focused on capital allocation, incentive structures, and just the culture at the top. And they call this the quote-unquote value creation model. So they get proprietary content, they drive productivity, and then they price for value. And that basically just means they increase prices because the customer has no other choice than to buy it. I mean, that's kind of an unprofessional way of explaining it. Howley would explain it like this, quote, in pricing, our goal was to price the product not to the cost, but to price it to what we thought the value we provided to the customer was, which is a mix of what you provide and what's the switching cost. Sometimes you can calculate that pretty closely, but frequently it's a little bit of a trial and error to get there. I subsequently found in almost every business we bought that most niche engineered product type businesses underprice their product. And there has been this instance, although many would call it more of a scandal than an instance, where the US Department of Defense, the DoD, found in an investigation in 2019 that TransDigm charged more than what the DoD calls the fair and reasonable 15% margin in 112 of the 113 contracts with the Defense Department. They could only do that by breaking down contracts into smaller quantities, because that way the overall volume was so low that TransDigm wasn't required to report on their costs and the margins, which is what you usually have to do if you have defense contracts.
This reminds me a lot of FICO, a company we looked at recently that has spiked prices very aggressively. It made the company very profitable, and the stock outperformed all of its competitors accordingly. But now they are in regulators' crosshairs for doing so. And the time when they may be able to still hike prices so aggressively to really boost their operating leverage, I mean, that might be over. That could be in the rearview mirror for the most part.
Well, that's one of the questions we need to figure out today. Just before the call, we talked about what even are the big bear cases for TransDigm. And to me, it was mostly when I started the episode, okay, how long can they go and take price without anyone stepping in? There have been multiple hearings throughout the years based on the findings of the DoD. And TransDigm once paid back, I think, $16 million and another time $26 million, which were considered excess profits. So they shouldn't have earned those extra profits or those extra margins. TransDigm repeatedly said that nothing they did was illegal, and yet they still voluntarily settled to pay those quote-unquote excess profits. And illegal or not, many of their products had profit margins of over 1,000%. So that's pretty unbelievable in business, and it just shows how far they have taken pricing power. And the main reason they could do that, and to some extent still do, is that they sell small, comparatively cheap parts. So the two most sold aircrafts in the world, for example, are the Boeing 737 and the Airbus A320. And both of them cost about $50 to $60 million to manufacture. And TransDigm's parts, in comparison, they cost an average of about $1,000. So it's just immaterial when you build a plane. And that's why, for a long time, no one cared when the prices of their products were raised by, let's say, 40% a year, because it just didn't move the needle for the OEMs or even the defense contractor. My father actually works for Airbus, and he told me that when a part is below $800 and it doesn't work after arriving, they just order a new one without even starting any refund process at all, because the costs of starting that process would just be higher than that low price part would be anyway. So it just shows that in the segment that TransDigm is operating, the price sensitivity is just not very high.
When I did my prep for this episode, I even came across this Charlie Munger quote on TransDigm where he shared his opinion on the price increases. And he said, "I don't like that way of making money. It's too brutal. They figure out something that has a little monopoly due to the Defense Department regulations, and they raise the price 10 times, and they're famous for it. I regard that as immoral."
I don't know about you, but when you just read the quote, I kind of heard the voice of Charlie Munger saying that in my head. I guess it's difficult to argue with the moral side of it. I mean, what adds to all of this is that when we talk about defense contracts, it's taxpayers' money that is spent. So paying 50 times the production value of a small part needed on a plane just feels kind of sickening when you know it's paid for by your taxes. So of course, I get how this feels immoral, but part of the truth is that the Department of Defense has been after TransDigm for about 20 years now. I think they started in 2002 with first looking into the business, and they opened many investigations, and yet none of them has ever had success. And if TransDigm had broken the law, I guess by now they would have been caught a long time ago. But even more important, if they wouldn't deliver on the quality or add enough value to their customers, so the OEMs and also the defense contractors, they simply wouldn't buy TransDigm's products anymore.
We will get to why TransDigm is so good at what they do and why customers keep coming back to them. But before we get ahead of ourselves, how about we get back to the history and the philosophy behind TransDigm? We just had this call about programmatic acquirers in our intrinsic value community. And after that, I realized even more how phenomenal these business models can be, where you basically have a team at the top that's just constantly making acquisitions of really high quality businesses to plug into their ecosystem. And so TransDigm is living proof of that. So I would love to learn more about how they're structured and what their M&A philosophy is.
A big part of the long-term success lies in how the company organizes itself. So TransDigm is a deeply decentralized organization similar to Berkshire Hathaway. So each operating unit is responsible for its own P&L, its own pricing decisions, and its own customer relationships. And the corporate office is intentionally small. I believe it's fewer than 50 people who actually work at the headquarters, but don't quote me on that. And it's basically only there to allocate capital and design incentive systems. So the philosophy is that the people closest to the customers are the ones that should actually make the decisions and not people behind desks somewhere at the headquarters of TransDigm. So when they went public in 2006, the model was still completely new to the aerospace industry. Aerospace suppliers were typically viewed as capital intensive and low margin businesses, dependent on the couple of OEMs that you have, which are mostly Boeing and Airbus, for growth. So TransDigm has pretty much revolutionized the industry with its new business model. And the second big thing that we will talk about today quite a lot are incentives. Like, that's a crucial factor in shaping both the culture and achieving the success that the company has had in the last 30 years. So senior executives, their compensation is heavily skewed toward long-term equity value creation. So bonuses and stock options only pay out if the company's share price compounds at high rates over multiple years. So management is highly aligned with shareholders. It's not unusual actually for TransDigm leaders to hold most of their net worth in company stock. And that not only goes for Nick Howley and the founder of that company, but also for the people managing all these subsidiaries. And that's kind of just the ownership mindset. And I believe that's one of the reasons why the business has stayed so disciplined for so long. Usually you see that approach in private equity firms, which is why that comparison is so often made. And I think even Howley, in an interview that I heard, said that TransDigm is a, quote, PE firm with public liquidity.
I think people could probably make a drinking game out of how many times an episode we mention either The Outsiders by William Thorndike or The Innovator's Dilemma. And you can take a shot now because we're talking about The Outsiders by William Thorndike. And it is one of my favorite books. And Daniel knows how much I love it. And, from everything you've told me, Nick Howley, who is the founder of TransDigm, I mean, I think if they were to do a second edition of the book, he would almost certainly be featured in it, which is almost the highest compliment I think I personally could give any founder or leader of a company. And you already said that Howley and his co-founder Doug Peacock were McKinsey consultants, which is funny because The Outsiders is pretty critical of McKinsey consultants generally. So I guess my question for you is, how did they get into the field? And then how did they go about, getting the idea to really revolutionize the industry with this PE-like approach to the afterparts aerospace market?
I think like Howley would be an exception. I think William Thorndike would put him into a second episode of that book, despite being a McKinsey consultant, because he actually had him on his podcast, which is called the 50X podcast. And Nick Howley has been a guest there, and it's a great interview, and I will also link to it in the show notes for everyone who wants to give it a listen. But yeah, their background at McKinsey was in industrial operations and corporate restructuring. So that wasn't too far off from what they would do later at TransDigm. And Doug Peacock was actually previously responsible for the aerospace investments for a private investment firm in New York. And I would assume that's probably where he got the original idea and the concept for TransDigm for. And Howley basically joined him early on, but not right at the start. So after a bit of time, he basically became kind of the architect of the operating model and also its public face. I actually didn't find any public interviews with Peacock, but I always found them with Nick Howley. He has done so many of them. And if you listen to them, you will quickly realize that he's obsessed with the idea of turning employees into owners by compensating them almost entirely on what he calls equity value creation. And that's what encourages them to make tough decisions, like raising prices whenever possible, divest low-return products, and constantly reallocate resources. And Howley said in the interview with William Thorndike that for much of his life, his dream was to own a niche manufacturing business, which I think is special. I mean, I don't know how old he was, but most kids don't necessarily grow up dreaming of owning niche manufacturing businesses, but apparently he did. And later in his life, he worked for a company called IMO Industries, which was a spin-off of Transamerica. And that's where he got the first exposure to both the aerospace market and also the M&A industry as a whole. And one other, I would say, shared belief of Howley and Peacock was that both were convinced that bureaucracy is killing innovation and accountability. And then they had this very unique view on leverage, especially for founders with a strong owner mentality, because most of them, as we know from looking at many such companies and also at such founders, they dislike that. Howley and Peacock, though, viewed that not as a risk, but more so as a tool to amplify equity returns. And again, that's very much a private equity mindset.
Yeah, I've got to quickly interrupt you here just because I would love to hear more about that. I mean, both of us like companies with very clean balance sheets, and usually that means not a lot of debt. So what makes them so confident that they can operate with these higher debt levels and not really put the shareholder at risk, almost more effectively compounding returns for shareholders?
We oftentimes get recommendations from listeners to look into some companies. And usually the first thing I look at is the balance sheet. And when I see a lot of debt, I'm immediately thinking, gosh, this company could be quite hard to understand and risky. And TransDigm's current net debt to free cash flow ratio is somewhere around 10 to 12 or 13. So depending on how you adjust free cash flow, it's really quite high. It has been significantly higher than that in recent years. And Howley's view is basically that there are only three factors that can increase a business's intrinsic value. You can either get the price up, you can get the cost down, or you can generate new business. Now, the capital structure is where he sees the potential to amplify the intrinsic value that you can create through those three drivers. And he did that by using quite a lot of that. At first glance, that level of debt just seems kind of reckless, especially for a manufacturing business. But TransDigm has significant recurring revenue. It's almost like a subscription-based company. So they know pretty well when and how much profit they will earn.
The recurring revenues come from the aftermarket sales, right? So when something needs to be replaced, OEMs have to return to TransDigm to order the part, as they're not really allowed to buy it from anywhere else under FAA regulations. Is that the correct way to understand it?
Yeah, and I mean, TransDigm pays really close attention when it comes to assessing aftermarket demand for its parts whenever they think about acquiring another company. So they know exactly how many seatbelts will be needed in 10 years' time after the first purchase. And the best proof of how well their business model actually works is just looking at past crises and seeing how TransDigm has managed them. There are two worth looking at, and I think that are mostly the global financial crisis in '08 and the pandemic in 2020. 9/11 would have also been interesting, but since TransDigm was a private company at the time, there's not that much data on it. I think it is pretty known, though, that TransDigm has been profitable and even growing during 9/11. And as you know, after the financial crisis in '08, the airline industry struggled a lot. They had significantly fewer passengers and lower revenue per passenger, leading to airlines parking or retiring entire fleets and basically reducing their workforce by quite a lot. And they also delayed purchases for spare parts and preferred to just deplete existing inventories instead of buying new parts and postpone refurbishments. And I mean, that's exactly the part that hurts TransDigm's business. However, once again, TransDigm's business was just growing. It kept growing despite all those headwinds. And the great thing about the aftermarket is that if you assume that air travel will not be down forever, at some point, planes need new parts again. And even if they don't fly, they are getting older. So for TransDigm, it honestly doesn't matter that much whether air travel is slow for, let's say, a couple of weeks, months, or as we have seen during the pandemic, even for a couple of years. I mean, the pandemic has really been the worst case scenario for a company like TransDigm. When global travel collapsed in 2020, TransDigm faced the sharpest commercial downturn in its history. I mean, air traffic fell by more than half. Major OEMs like Boeing and Airbus slashed production, and airlines grounded their entire fleets. And despite that, net sales and adjusted EBITDA only dropped by a bit more than 10% during the entire pandemic. So that's where TransDigm's diversification also paid off, because this is a company where the commercial aftermarket sales plunged more than 40% across 2 years, but they're a bit diversified because they do have these defense contracts. And the defense business remained comparatively stable, going to roughly half of total sales as military procurement continued even through the lockdowns.
Although it's not a subscription business directly, it definitely has the same characteristics in some ways. And when I compare it to some of the subscription businesses that we've owned or looked at in our portfolio, like Adobe or Salesforce, I mean, it's pretty astonishing to see how much more pricing power and stickiness this business actually has. Just goes to show you that you don't actually have to be a subscription business to have some of those really high quality attributes behind you. And so coming back to the people who, to a large extent, created this business model, Peacock eventually stepped back from the company, but Howley, as we know, stayed on as CEO and then later executive chairman. And so for the last 7 years, Kevin Stein has worked as CEO, but then he retired this year too and really mixed things up again. So, in your Berkshire and Copart episodes, you discuss how important the change from founder to another CEO is in determining how strong the culture actually is. And so in that spirit, I'm curious, how would you assess this change here with TransDigm, and what do you make potentially of the new CEO now? Even Einstein had blind spots. That's why modern science is built on the idea of peer review. Investing may be more art than science, but that doesn't make peer feedback any less valuable. The tricky thing is finding qualified people who are interested and willing to help vet your investment ideas. That's why we built the Intrinsic Value community. It's a place to connect, share ideas, learn, and get feedback. Nobody ever wishes they'd spent more time buried in spreadsheets, but connecting and building relationships with others who may be smarter on a topic than you, but who are also schooled in value investing, that's valuable. We make spots in this exclusive community available in cohorts every few months, and last time around, our 30 available spots filled up pretty quickly. If you're interested in our next cohort, which will be even smaller, you can join the waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. Support for the show comes from public.com. You're thoughtful about where your money goes. You've got your core holdings, some recurring crypto buys, maybe even a few strategic option plays on the side. The point is, you're engaged with your investments, and Public gets that. That's why they built an investing platform for those who take it seriously. On public.com, you can put together a multi-asset portfolio for the long haul. Stocks, bonds, options, crypto, it's all there. Plus, an industry-leading 3.8% APY high-yield cash account. Switch to the platform for those who take investing seriously. Go to public.com/TIVP and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/TIVP. Paid for by Public Investing, full disclosures, and public.com/TIVP. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
Well, with Berkshire and Copart, you really had two companies whose culture is seen as a positive example of how companies should conduct business. Within the company, it kind of feels more like a family than a Wall Street firm, at least that's how it seems to the outside. And when dealing with customers, those companies are known for creating win-win relationships. With TransDigm, you have, and I say that now for the 10th time today, more of this PE culture. So it is successful, but I don't see them, winning prizes for how comfortable each employee feels or how well they treat their customers. I mean, you mentioned what Charlie Munger thought about the company before, and nevertheless, the CEO changes worked very well in terms of keeping the performance up. I mean, former CEO Kevin Stein and the new CEO Mike Lisman both spent many years at TransDigm before getting the CEO position. And I think both understand the company culture pretty well. And TransDigm also holds regular so-called culture meetings where basically the management and executives visit the subsidiaries they own to discuss what's important to the company. So I don't expect any changes in how the business and also the subsidiaries are run. Lisman, for example, previously led the company's M&A group and served as COO, CFO, and executive vice president. So if anyone knows how the business works, it's definitely him. But having said that, the CEO change did come a bit out of the blue. I think the market didn't really understand why it happened. I mean, Stein did a good job and his resignation came at least unexpected. He hasn't been there for so many years that you could say he just, goes to retire. That said, I talked to some investors in the company and they all trust that Lisman will do a fantastic job and that he is the right guy for the job. So sometimes there are just, personal reasons for anyone stepping down. And it's not like Stein will not be with the company at all. He will still remain on the board. So I don't think this is a reason for concern.
Well, we like to look at management. We like to look at compensation and incentives. We like to look at track record of returns and just general business quality. But I think the other elephant in the room here is TransDigm's moat and really looking at the economics behind their product. So if they achieve margins of 1,000% or more and do so for decades, there does have to be an incredible moat there that is preventing competition from coming in and pulling down their profit margins. And for some reason, we can't help ourselves but to bring up Adobe in every second episode. That could be another part of the drinking game. But while TransDigm's price gouging is on this whole other level, Adobe has gotten its fair share of price gouging acquisitions from users as well, too. And that has not really damaged the business yet, right? Despite that, churn rates do remain pretty low for them because there's just simply no equal alternative for the majority of users. So these price hikes are really just them more effectively capturing a larger share of the consumer surplus that they're creating. With TransDigm, you have multiple advantages that I think make it even stickier. Your customer base is mostly price agnostic. The industry is highly regulated and barriers to entry are high. So competition is low and FAA regulations almost guarantee a product life cycle of multiple decades. So does that summarize things well to you?
I couldn't have done it better, honestly. I mean, I agree there really has been some backlash on Adobe's pricing, and if anything, it has gotten worse over the years, but it doesn't compare to TransDigm's backlash. I mean, to get an idea of how controversial TransDigm and its pricing techniques are, I watched back old hearings and court videos, and that helped just getting a sense of how much spotlight the company already got for its practices. And trust me, it's a lot. It's not even close to comparable to what Adobe is experiencing right now. I came across an 8-year-old video of a research analyst who was pretty confident that TransDigm's time is over and their quote-unquote fraud will end. And at the time, TransDigm was even compared to Valiant, and Valiant was a pharmaceutical company that acquired other companies and afterwards aggressively raised prices of its drugs. However, the company was also found guilty of multiple times of accounting fraud. So not only is the case different because the product in question is medicine and the customer is the end consumer and not another business, but also because it was not only morally, at least questionable, but it was plain and simple illegal. And as we know today, TransDigm did not share the same fate. Instead, since that analyst's call that the fraud will end soon, the stock is up 400% and TransDigm's business model is completely untouched. And there are a couple of points for why TransDigm can get away with these price hikes. I mean, the first is just the nature of their products. We talked in the beginning about simpler products like the seat belts or like cabin doors, because that's kind of more tangible than, let's say, some highly engineered motor parts. But most of what TransDigm sells are such highly engineered components that are just mission critical, but still account for a very small percentage of an aircraft's cost. So a part might cost a couple of $1,000s, but when it is broken and the plane is not allowed to start, a grounded commercial plane, depending on its size, can cost up to $150,000 per day. So once a part is certified and in production, OEMs definitely optimize for reliability and on-time delivery. And price sensitivity exists, but not to a large extent. I mean, as you said, OEMs and defense departments are mostly price agnostic.
Oh, I've got to just go back to that Valiant Pharmaceuticals comment, because that is such a fascinating case study for anybody who is looking to better understand the red flags of fraud. But also, I mean, you had this real battle between Bill Ackman and Carl Icahn, who were on opposing sides of it. So, these kind of two titans of Wall Street really fighting it out over this company, and ended up working out in one's favor and less so for the other. But I won't give away any spoilers. But this kind of dynamic where it does cost $150,000 per day to not have your commercial plane operating, I would imagine that is why TransDigm leans so heavily on aftermarket exposure. Commercial aftermarket is actually an explicit pillar of the model, and together with the defense aftermarket business, these are the profit engines that really fund everything else. And on the screen right now, you'll see a graph where there's a product breakdown of TransDigm. And about 90% of the products they sell are proprietary products, meaning only TransDigm has the right to manufacture and sell these products. You can also see that while the business is only active in one sector, it is at least diversified in the sense that defense, commercial OEMs, and the commercial aftermarket split the business relatively evenly. And as you said, when we looked at the different crises, they do behave differently. So one segment can support another in times of lower demand. The defense contracts, for example, tend to be pretty robust, even during times when commercial travel is struggling. So there's some kind of internal diversification that helps the business to keep chugging along, really no matter what's going on. It's also interesting to see that the aftermarket accounts for about a third of TransDigm's revenue, but 75% of its EBITDA. And EBITDA is a number we don't love, but it is, treated as a rough proxy for operating profits. And again, it reminds me a lot of a business like FICO, where, they have this kind of one golden goose that makes up a chunk of the sales, but a much, much bigger portion of the profit because of the pricing power that they have.
The great thing, if you compare to FICO, is that TransDigm is really a company consisting of 100 different monopolies that share this same characteristic. So yes, the aftermarket is where TransDigm makes its margins, and many companies actually sell parts to OEMs at a loss and survive only on the aftermarket business. Howley once said that the biggest mistake most companies in the industry make is underpricing their products and failing to understand their true value. Even at the first sale, I think TransDigm rarely loses any money at all. And this is where TransDigm's scale also plays a part. I mean, scale doesn't matter in the way that it usually does, since all of TransDigm's subsidiaries run independently. So they set their own pricing, they negotiate directly with the customer, and there are no synergies between these acquisitions and all the companies. However, while each business acts locally, capital allocation and also just the strategic discipline, they all are centralized. So not only can subsidiaries use the pricing data across thousands of different products and programs, but they can also benchmark elasticity. So basically how much is, for example, the OEM willing to pay here competitive intensity, if competitors even exist within that product range, and then also customer response across the entire product portfolio. But the most important part is that smaller suppliers, they often depend on OEMs for survival, and they just can't afford to push back on pricing. In the end, they're only Boeing and Airbus as potential buyers, so they do have a lot of leverage too on their end. And when a company is part of TransDigm, it doesn't have the same worries about going bankrupt or at least taking a huge hit if OEMs don't immediately accept the pricing. And OEMs probably also know there just won't be another supplier who can offer a product at a lower price. And I think those are similar dynamics to what we discussed in our Berkshire episode as well, where I said, especially for those cyclical manufacturing businesses, I just like the idea of being backed by Berkshire with a lot of money and with a lot of leverage in the background to negotiate prices. Because ultimately, these niche businesses, they are highly attractive for the first mover, but they tend to be relatively unattractive for companies that want to break into them. An entrant would need to spend hundreds of thousands, and depending on the product, sometimes even millions of dollars in R&D to design a competing product, and then they would need to go into production without the scale advantages that the first mover has, and then they have to try to convince customers to actually buy their product. And that might sound easier than it is, but it kind of reminds me of this dynamic that we often see in asset management. I mean, have you ever heard of a fund manager who was fired for owning Apple stock? Because I certainly have not. So even if the stock underperforms for a while, you won't get fired for holding a stock that everyone else holds as well. If you, though, hold a stock that is relatively unpopular and that stock underperforms, that's when you get into trouble. And I feel like the dynamic is similar here, where no one gets fired for buying a part from TransDigm, even if the product might be a bit too expensive. But if they decide to go with an unknown competitor and anything happens or it doesn't work out, they will definitely get into trouble. And then you also have the argument that you can barely even make a price argument. So if you are an entrant and you were to undercut TransDigm's price, well then I think TransDigm would simply flex its muscle and lower the prices further until the competitor basically bleeds out because they lose money every time they sell that product.
It kind of reminds me of like if you are the manager of a sports team, the owner of a sports team, you're never really going to get in trouble if you sign the big name star, even if you massively overpay. Maybe they're not playing the position that you really need. They're just not a good cultural fit. The fan base is not going to rebel at you because you signed, their favorite player, even if it was not actually what is the best decision. And that's kind of what I'm trying to say with like career risk with Apple. Like you're probably not going to get fired for buying Apple stock, but there are these other types of investments that may actually be more appropriate or better bets. But because it's not a mainstream thought, that kind of deviance from the consensus is what actually can cause you to lose your job. And I think this is all really a part of why TransDigm's M&A strategy is so focused on only buying companies that are the sole source producer of their goods. So when they enter the market, there is no alternative. There's no really way for them to even be wrong on whether they're betting on Apple or some, deep value bet. And every entrant would face the exact problems that you just described, making it really almost certain that TransDigm will continue to operate in a monopoly.
I guess it's fair to say that the regulations in the sector, as well as the economics of the business, are kind of like a guaranteed monopoly. I think it's important to mention, though, that it's really a mix out of the two of them. So I don't see it as a government-granted monopoly, but one that TransDigm has mostly created for itself. And one of the hearings I watched, a Department of Defense employee explained why they can't do anything about TransDigm. And I think it's kind of interesting, so we should quickly listen to that.
Understanding that procuring in the sole source environment is difficult and can lead to exploitation, have you or anyone else made efforts to instruct contracting officers to actively look for parts that could meet the requirements that are similar to those produced by sole source providers?
Yes, Congressman, that's part of the market research that's undertaken across the department for commercial items. In this particular instance, we're talking about national stock items that the Defense Logistics Agency is responding to the requirements of the military departments. Most of those parts are specified, whether there's an alternate source or alternate part. That's part of the calculus, but in most cases, there is one particular part, and in many of these cases, one particular manufacturer for the part that's available. That's a function of the dynamics of the market, where only one provider is making that particular item. And if that's the case, and then we're into the scenario that we're talking about today, negotiating on a sole source basis.
Are there any efforts to increase competition in the spare part space? Can you think of anything we could do?
Well, the reverse engineering is a good example. I want to downplay how the extent to which we can use that across the board for every part. We really can't. Each one of those requires the engineering analysis behind it. But ultimately, what we do there is we have the technical data package that we can compete the spare parts once we go through that process.
I think the difference between a natural monopoly and a government granted one is quite important. Natural monopolies tend to perform very well over prolonged periods of time. And this is what Peter Thiel writes about in his book, 0 to 1, while government granted monopolies can in some ways become victims of their own success. And price is a good example. Being a monopoly generally comes with having pricing power, but for government granted ones, there's really a limit to how far they can take the price until regulators say that enough is enough. And it seems like the government has tried to do that with TransDigm. And the fact that they couldn't, at least for now, I think does show that TransDigm has a monopoly that they actually really organically earned. They have a natural monopoly just from their own superior strategy and operational excellence, despite also being a beneficiary of FAA regulations that have favored them over time. I don't think they're the winner solely because of those regulations, if that makes sense.
Yeah, I believe it's simply to mix it up, because TransDigm has clearly used regulations in their favor, but the moat is based on being the sole producer for most of their parts. I think the market share in that is like 75%. So 75% of their products, they are the sole producer for. And that's not because it's a closed market, but because of the economics of the business and the fact that TransDigm scale advantages have simply built over time. And it's incredibly difficult to break that now.
And that has led to phenomenal margins. Just to give listeners an idea of TransDigm's margins compared to other companies in the aerospace sector, TransDigm has gross margins of 60%, which is pretty dang good for a non-tech company, and operating margins of 45%. And so TransDigm's customers, the OEMs like Boeing and Airbus, operate at margins of like 7 to 10%. Well, airlines, United, Delta, they have even more razor thin margins in the low single digits. And they not only outperformed the other sectors in aerospace, even when you compare TransDigm with other manufacturing serial acquirers, not a single one, no matter in what industry they operate in, has really a chance of coming close to TransDigm, which boasts these EBITDA margins of over 50%, while the closest competitors barely reach 30%. The returns on invested capital are also relatively high at over 20%. And I guess when we talk more about the M&A playbook, we can also discuss the successes of the more recent acquisitions and try to get an idea for their ROIC, which is not returns on invested capital, but returns on incremental invested capital. And that's another piece of jargon for you, but it's meant to give us an idea of how profitable and value accretive new investments are. We understand how really returns are expected to look going forward, as opposed to just looking at, maybe some of the great investments they've done in the past that are biasing their overall profitability today. And one thing I want to ask you about TransDigm is the use of EBITDA. We both have criticized that metric before. Buffett and Munger hate it, yet it is really of special importance to management and the entire company's incentive structure and management structure. So how does that land for you? How do you feel about this incredible compounder that's done such a great job compounding wealth that at the same time relies on what we both see as being a very flawed metric?
EBITDA is very unpopular, especially in value investing circles. And I would say in many cases, it's fair to refer to Charlie Munger's description of EBITDA as quote-unquote bullshit earnings. But Nick Howley views it as the most important metric for TransDigm. And that is really a private equity approach to business. In private equity, nothing matters more than EBITDA. And TransDigm uses a specific version called EBITDA as defined, which I will just call adjusted EBITDA going forward for simplicity. And it basically starts with normal EBITDA, so earnings before interest, taxes, depreciation, and amortization. And then it adjusts for a few recurring technical items. So the main idea is basically to have a number that reflects the operating activities and is not impacted by any expenses related to M&A, financing, or really anything outside of the day-to-day operations.
And it's also the metric that their lenders care a lot about, right? I mean, the company's debt covenants, management bonuses, and acquisition models really all revolve around adjusted EBITDA, for better or worse. So when they are talking about leverage or when they're evaluating a new deal, they really do need to do it in terms of adjusted EBITDA. So there's just something practical to it.
Yeah, it's like everything revolves around adjusted EBITDA. I mean, if you go through their annual reports, their earnings, I don't think I've read the term adjusted EBITDA or EBITDA as defined as often as in any other company that I looked at. But the reason it is often used with PE companies is that it just makes a whole lot of sense for companies that acquire a lot of other companies, because it basically helps you evaluate how efficiently each new business turns sales into profit, regardless of how the holding company is financed. So it's just a good proxy for operating cash flow that is removing the impact of financing, taxes, and accounting decisions. And that's what matters for a company that just wants to compare what company should I acquire, how well is it actually benefiting, or is it value accretive to the overall enterprise. And having said that, it is not a good proxy for free cash flow. In fact, the goal of TransDigm is to convert about 50% of adjusted EBITDA to free cash flow in any given year. So there is quite a sizable gap between adjusted EBITDA and the free cash flow. And as you said before, usually cash flows are everything we care about because they are what ultimately finance shareholder returns in the form of buybacks and dividends. And obviously, that's how you also end up paying for things like the interest on your debt. And a company like TransDigm is an expert at using debt to finance acquisitions and just shareholder returns in general, but cash flows are mostly used to fund needed expenses and the interest on that debt. And looking at the interest coverage ratio, which basically shows you how much more profit you earn relative to the interest expenses, there's no reason to believe TransDigm will run into any problems soon. Currently, they earn about 2 or 3 times more money than they have to spend on interest.
I'm sure we could talk about debt for a while, but you did just mention the incentive structure. So how about you tell us more about how exactly that is broken down for this company?
I guess it's fair to say that TransDigm's incentive system is one of the most extreme in corporate America. I mean, it's built to ensure that managers from the CEO down to individual business unit leaders, how they call it, think like owners rather than just operators. And the system it's really unapologetically tied to equity value creation. So the philosophy traces back to Nick Howley, of course, and his idea of incentivizing his employees. When he co-founded TransDigm, he believed that fixed salaries and short-term bonuses should be as low as possible, and nearly all wealth creation should come from just long-term stock price appreciation. As he puts it in one interview, he said, "You can't motivate people to behave like owners if they don't have something meaningful at stake." And meaningful is the right choice of words because for senior executives, roughly 80 to 90% of total compensation is performance-based. So the fixed base salary makes up something like 1 million to 1.5 million per year for the top executives, including former CEO Kevin Stein and executive chairman Nick Howley. And this typically represents less than 10% of their total annual pay opportunity. And then the cash bonus basically ranges from 75% to 125% of the base salary. So that's adding another 10 to 15% to the potential entire compensation package. But what it's really about is the bonus, and that is primarily tied to the adjusted EBITDA and free cash flow generation. So revenues play no role at all, which is something that we always like to see. It's basically just about the metrics that matter for shareholders. And that's where the remaining 75 to 85% of compensation mostly come from, those multi-year stock option grants that only vest if 2 conditions are met. And the first is simply the time bound, right? You have to stay a certain time at the company to get your options. But the second one is that it requires the company's stock price to increase or to compound at a specific rate. So the compound annual growth rate, which is what we often just call CAGR. To be precise, the options only vest if the stock compounds at a minimum of 10% and and the full number of options vest if the stock compounds at 17.5%. I think it's quite funny that it's probably not a surprise that in recent years, the compound rate for the stock has actually been 17%, so pretty close to that upper bound. And I guess you could just summarize it by saying you get what you incentivize for.
I think that's true. I'm just in the research process for my episode that'll be coming out next week. And without spoiling anything, I can already say that this incentive structure is really something that I can't wrap my head around in terms of what they do. The company performs very well, but the incentives are just, gosh, they're so awful. Stock grants are mostly based on tenure, and performance payouts are based on revenue, which, as you just alluded to, I mean, neither of those are great ways to incentivize management to create long-term shareholder value per share, with the emphasis being per share. Obviously, you want to see revenue grow, but the problem is that there's just so many ways to boost revenue that may barely add really anything to the bottom line, right? Anyone who's ever run a business knows that they can definitely grow the business, but it may not necessarily be profitable. So that's the wrong thing to incentivize for. And again, it has worked well for this company that I'll be covering next week, but it's really refreshing to see that TransDigm has just such a great incentive structure.
It might be one of the best that at least I personally have yet looked at least if you can accept the fact that it is about EBITDA instead of cash flow. But this is just how the company works. And as I said, in the bonus structure, they also have both EBITDA and free cash flow as metrics to basically compensate the management with. And another thing that I like to see is that executives are also required to maintain a substantial personal ownership stake in the company. So the CEO, for example, must hold shares with a value equal to at least 10 times his annual base salary. And other top officers must hold between 3 and 6 times their base salary. So, of course, in practice, most executives far exceed those minimums anyway, because they all made a whole lot of money in the last 30 years holding TransDigm stock. I mean, Nick Howley, for example, who still serves as executive chairman, he owns roughly $3 to $4 billion worth of stock. And former CEO Kevin Stein has built a stake worth well over $100 million, and he has only been the CEO for less than 10 years. And many operating unit leaders have tens of millions in vested equity. So there have been a few companies that have made their executives and basically all their managers as wealthy as TransDigm has done.
Yeah, so on one of our latest calls in our intrinsic value community, which is a community we run as kind of tangential to this podcast for some of the most passionate listeners in our audience to connect with other really sophisticated investors and just support each other in this journey of learning and investing. And we hosted Noah Snyder from Snowball Capital as a virtual guest speaker to the group. And it was just so deeply insightful. I mean, he's an expert on serial acquirers, or as he would call it more precisely, programmatic acquirers, where programmatic acquirers have this disciplined, repeatable process to acquire and improve other businesses instead of maybe just acquiring them and letting them run themselves the same way as they did before, which is sort of more akin to maybe the Berkshire Hathaway model. And from everything you told me, TransDigm definitely is maybe the epitome of a programmatic acquirer, which is also why they fit the private equity comparison a bit better than some of these other serial acquisition companies. And how about you lead us through their M&A playbook and this approach that they take for integrating those acquisitions into the broader parent company structure?
We didn't focus too much or even at all on TransDigm in the call, but I did see the company on one of those slides, and it's obvious because they have a very detailed plan for what needs to happen at a company after they acquired it. And the whole process basically already starts before the acquisition. So we've said it 10 times today, but it still all starts when TransDigm goes on the hunt for companies with proprietary sole source products with long aftermarket tails. And it's not always easy to figure out how much potential the aftermarket actually has, but that's a crucial part of the process. When they find a company, they buy it only when there's a clear path to 20% returns for shareholders. In an interview, Howley said that they usually look for 25% IRR at least, just to have a margin of safety to reach the required return. And you mentioned the return on incremental investment before. And when we look at the past deals, TransDigm usually ends up with an ROIC, so the incremental return on invested capital, of about 25 to 30%. And they're pretty clear about what they look for and what they do not look for. They do not care at all, for example, about things like synergies, market share, diversification, and all of the stuff that you usually see on any slide deck of M&A, investment bankers, and all of that stuff. They just want to see adjusted EBITDA growth. And most of the time, they acquire a company, and the first thing they do is cut the workforce, negotiate pricing, and cut unprofitable or low margin businesses. And they start implementing the same management incentive structure that every single TransDigm business has. And in their Investor Day presentation, which is, I think, from 2024, they showed a timeline for the acquisition and the integration process, which we currently have now on the screen for anyone watching on YouTube or Spotify. And I think it captures everything from teaching the TransDigm culture to controlling working capital, evaluating the key staff and efficiency within the operations, and just reviewing and potentially almost always renegotiating contracts, and basically just organizing the entire company to fit the, let's say, TransDigm way, which is not a term they use, but I just made up. And I think it's an incredibly precise process for how they go about it.
What is the usual acquisition size here? I mean, we're talking about deals that are for hundreds of millions, billions, or tens of billions of dollars.
So usually TransDigm focuses on small and mid-cap acquisitions. So the biggest acquisition yet has been Line Technologies in 2019, and that was a price tag of about $4 billion. And Line was a solid performing aerospace supplier with, I think, mid-teen margins. And when TransDigm came in, they basically simplified the business. I think they sold about 8 operating units for a total of $1.3 billion. And they renegotiated pricing on all the core products. And 5 years after the acquisition, EBITDA margins went from 15% to almost 40%. And this is, by the way, not cherry picking. I mean, from the close to 100 acquisitions that TransDigm has done, not a single one was a loser. And as far as I know, every single one reached the 20% threshold for the IRR. And that's what Nick Howley says and claims on multiple interviews. So you kind of have to believe it. But looking at the stock chart and just the fundamentals, it seems like they have a pretty good hit rate with their M&A acquisitions.
When I look at TransDigm's market cap at $75 billion, it does feel like we're starting to get to a point where the law of large numbers starts to affect things. Small acquisitions don't move the needle as much, right? So, I mean, this is a company that's really far from being a small company by any definition. And you mentioned almost 100 acquisitions. And I just wonder how much room for growth there is looking forward, which is, of course, the key consideration for us as investors who would be buying in at today's share price and haven't benefited from the wonderful, wonderful returns that they've been able to generate over the last 2 decades. And they do have this strict acquisition criteria, and that, they focus on size. And so I'm just wondering how many more companies there are in this kind of addressable universe for them that can move the needle and still be of the same quality for TransDigm to continue to basically just buy companies that are system critical manufacturers with monopoly-like positions that are big enough to move the needle for shareholders.
I asked myself the same question, and I think the market is also doing the same. I mean, one reason for the poor performance this year is that TransDigm hasn't been very active in the M&A market, while competitors like Heiko, for example, have closed multiple deals. So one interesting thing here that I kind of quickly want to mention, though, is to look at the distribution of returns that TransDigm has achieved in the past, because I think it's just pretty remarkable how equally distributed they are. I mean, TransDigm has achieved an IRR of 36% for over 3 decades, and the first 20 years, from 1993 to basically 2006, so a bit more than that, were the private era of the company, and they achieved 36.5% returns in that time frame. The next 20 years, so from 2006 to today, the return has been 35% a year. So even in the last 5 years, TransDigm has achieved a 25% CAGR. And I mention all of that because it just shows that despite the phenomenal growth that the company has seen, TransDigm has never struggled to keep growing at an incredibly fast rate, even when the company was worth tens of billions of dollars.
You don't need me to tell you those numbers are incredible, because they are. I mean, it's hard to fully grasp how extraordinary those returns are. And to maybe partially answer my own question from before, throwing it back to you, one clear tailwind for TransDigm that I can immediately think of, I guess, is the continued growth of the aerospace and travel industries. And for anybody who's heard our episode on Airbnb, we do believe that travel will become per capita and total travel will continue to increase as more and more people meet middle income thresholds that enable them to travel. So the long-term chart for global air travel really has only moved up and to the right for decades. And with this growing middle class and emerging markets, like I said, it's just hard to imagine that trend reversing anytime soon. And that should be a boon for TransDigm's continued business.
Well, it's definitely one of the major macro tailwinds that the company has seen. I mean, last year, the COVID hit to air travel was finally overcome. And this year, we have more kilometers traveled by plane than ever before. And growth is projected to be between 6 to 7% per year until the end of this decade. And as you just alluded to, I guess it won't look much different in the decades ahead. If anything, especially in the emerging markets or seeing the push from the emerging markets, the growth rate could just accelerate further. And it's similar for the installed base. So all the airplanes that are currently used, it's obviously at an all-time high as well, and it's projected to grow about 3% a year. So there are a lot of tailwinds. And mentioning them, there's one other that I think is quite interesting because over the last 10 years, the fleet age, so the average age of an aircraft, has risen significantly. And airlines have been slower to retire older planes because of supply chain bottlenecks at the OEMs like Boeing and Airbus. And they just delayed deliveries of new aircraft and the need to maintain capacity as passenger traffic rebounds. And a higher average age means thousands of aircrafts are flying well beyond their original maintenance schedules. And that means they require more frequent component replacements across exactly the kind of subsystems where TransDigm dominates. And that should mean higher aftermarket sales for TransDigm. And I think I can also take a bit of fear when it comes to the question of how many more parts there even are that TransDigm could get into by acquiring companies. I mean, the global airline operating expenses are about $850 to $900 billion a year. And from that, about 15% are maintenance expenses. And from those maintenance expenses, TransDigm is active in 47%, so pretty much half of the entire market. And that leaves TransDigm with an addressable market of about $60 billion. I know that's a lot of numbers, but give me a minute more and you will see why I'm so bullish on this. Within that $60 billion pool, TransDigm currently captures only around 3%. So that's what we're talking about, $1.7 billion of annual commercial aftermarket revenue. And the market is still vastly fragmented with thousands of small specialized manufacturers that are potential targets for TransDigm to acquire in the future.
And there haven't been many acquisitions this year, two to be exact. TransDigm spent about $900 million to acquire Servotronics and Simmons Precision Parts from RTX. Heiko, on the other hand, one of TransDigm's competitors and a company that Clay Fink has covered a couple months ago on our sister podcast, We Study Billionaires, they've already made 5 acquisitions this year.
Yeah, again, I think that's one of the reasons why the stock, and I mean TransDigm this time, hasn't performed that great this year. I mean, the primary reason has been a disappointing Q3 earnings report with aftermarket sales lower than expected. But a lack of M&A probably didn't help either. I wouldn't panic though, because I've spoken with a friend who owns both companies, so TransDigm and Heiko, in his fund, and he's also spoken with the management teams of the companies. And when he asked Heiko what they thought of TransDigm's weaker aftermarket sales performance, they basically said it sometimes happens and they wouldn't expect any structural problems whatsoever. And when we compare acquisitions, which is kind of what you're getting to, is the fact that we have to acknowledge that TransDigm is by far the most selective acquirer in the industry. So Heiko acquires companies that TransDigm just wouldn't acquire due to doubts, for example, about their monopoly position or the aftermarket fit, and therefore also missing on their 20% IRR targets. And a recent example has been the acquisition of Gables Engineering. I think that's a company that Heiko has acquired, and I think TransDigm wouldn't have made that deal. I mean, you just don't really know if the aftermarket demand is actually there for their products. So I think when in doubt, TransDigm does not make the deal and they wait for those clear home runs. And Loa Holdings is another competitor, but they are much, much smaller than TransDigm, so they can just acquire companies that simply wouldn't move the needle for TransDigm. So I think there's the comparison kind of lacks there.
We've already talked about potential risks in the business model here and there, but when you summarize them for us, what would you say are the main risks that you're most worried about as a potential TransDigm shareholder? And I don't think either of us own any underlying shares yet, but if we were to, what would keep you up at night?
Well, I think I mentioned earlier in the call that before our recording here, we talked about, okay, what are even like the big bear cases and the big risks with like owning TransDigm? And we couldn't really think of any material ones. I think what we will do at some point is hosting a call in our community because we have some experts there on both air travel, but also just people who are rocket scientists who probably still have at least somewhat of an insight into this company, and ask them if they can see any like huge, maybe even terminal value concerns. Because the one we talked about most today is pricing. As investors, there's usually nothing we want more than strong pricing power. But when you push it so far that it's basically all over the national news and you have hearings with the government officials about it, I guess that you just have taken price a bit too far. And to be fair though, while the numbers sound dramatic, I do believe that the reality is that the items with margins of thousands of percent that you see on national news, they're just low volume parts. And with decades of certification history and just no alternative supplier, to some extent you can take those prices, and they're not the average TransDigm product. So after a brief period of what you might call political theater, TransDigm voluntarily refunded, I think I mentioned it before, $26 million one time and then $16 million the other time, so about $40 million in total to the Pentagon, which is honestly for a company of the size of TransDigm, barely a rounding error on its balance sheet. And the investigations ended with no structural change to their business at all. So I personally do not think that you will see anything in that direction in the next years to come, but you never know. I mean, they're still pricing the same way, so there is some uncertainty about that.
Sometimes you and I like to use these very simple, maybe even amateurish ways to assess companies, investment opportunities, and even risk. Or we've joked in the past that some of my best investment ideas, I guess, have come from just literally staring at my phone and thinking about what apps I rely on the most. And when we're thinking about risk, the kind of intuitive barometer we use is, well, would we sleep well at night owning this stock? If I put a chunk of my money or maybe my parents' money into this company, would that affect how I sleep? And now that you've learned more about the company, you're probably in a better position to answer that than me, but I can see how it might be difficult to feel comfortable owning a business that's really just constantly in the headlines for alleged price gouging when it involves taxpayer money, especially at a time when the government has been shut down and there's all this attention around government spending. Does that keep you up? Does that worry you?
That's a good point. I actually think that is kind of why it's such a public debate anyway. I mean, OEMs are probably not happy with the price increases either, but they just know how the market works and they wouldn't spend the money if there were an alternative. But when it's about taxpayers' money spent on defense contracts, then people are rightfully mad when they hear a company earns a 4,000% margin on a product that should only have a 50% margin. So I kind of get the doubts there. Again, it's kind of a topic that I see as mostly closed, but it could open up anytime. And I don't know if I could sleep well knowing that the company I'm invested in is all over the national news for price gouging.
What about leverage? Do you consider that to be a problem? I mean, we usually love to see these super clean balance sheets, and we've been spoiled with some of the big tech companies we've looked at where you have comfortably more cash to pay off debt. And part of it is because they rely so heavily on stock-based compensation to run their business that they can produce a lot of cash, but maybe it's not reflecting the true cost of the business. Yada, yada, yada. That's a whole argument we could have. But still, this is a company with a lot of debt. TransDigm is really the opposite of some of these businesses we've really come to love.
I mean, the closest business that we've covered here on the show, it was actually one of my pitches, is Berkshire Hathaway. And Berkshire has $300 billion in cash on its balance sheet. This company has about $2.5 billion. So obviously, when I look at the debt levels, they are concerning at first glance. I mean, you have a net debt to free cash flow ratio of around 11, 12, 13 times. It depends on how you adjust free cash flow. And the model just leaves what seems to be little room for error or just prolonged downturns in what is a cyclical industry. But right now, it looks like interest rates are going down rather than up in the near future. But you do not want to bet on that. And we have seen many things in the last decade that no one could have expected. And that's actually one of the reasons why we do not like that usually, because you suddenly see yourself doing some form of micro calls. That said, though, we talked about the past crises and the pandemic years, for example, and even when COVID hit. And really just delivered the most severe blow to Air Travel that you could imagine. TransDigm didn't have any stress at all meeting its obligations, and management argues that the risk is mitigated by long-dated, mostly fixed-rate debt, and also the ability to just pull back on acquisitions or dividends if necessary.
So one of the funky things you told me is that they took on $5 billion in debt to then pay this special dividend, and special in the sense of that it's not a recurring dividend. It's this one-off dividend payment of $90 per share, which is really substantial. And theoretically, I guess if that cash comes at a lower cost of capital than their retained earnings, which can be plowed back into acquisitions, and maybe you could justify the use of special dividends in this way. Not that the cost of debt financing is as cheap as it has been in years past. But anyways, I mean, it's atypical to say the least. And we're used to seeing companies that either don't pay a dividend because they're just pouring all of their capital into reinvestment, or they're buying back shares because they believe that maybe the company is undervalued, or they're trying to offset stock-based comp dilution, or they pay a stable and consistent dividend that attracts certain types of investors that treat the stock as sort of a source of income or an alternative for a bond. We don't see a lot of companies, especially taking on debt, to just periodically pay these massive dividends without a lot of like heads up for when that's going to happen. So I've got to get you to tell me more about that.
It's totally true. I think it's the only company that I've seen doing this. Not only pay these huge dividends with basically no warning before that you will receive them, but also just financing them totally with debt. And I think this is where it kind of gets somewhat tricky. I mean, it seems kind of arrogant to look at this move and then criticize management for it, because TransDigm has operated like this since its inception, and it has worked off tremendously well for everyone involved. And at the same time, it does leave at least a bit of a weird feeling for me. I mean, after raising another $5 billion in debt, that brings the total amount of debt to almost $25 billion. And this is a company doing about $2.5 billion in free cash flow. So sure, cash flows are growing and they are very predictable, but it's not necessarily the total amount of debt that I have a problem with. TransDigm has always issued long-term debt with fixed rates, but we're not in the post-08 zero interest rate era anymore. So when all that debt now matures and has to be refinanced, TransDigm will see its average interest rate increase quite significantly. You can actually see the impact of that in the rise of interest rate expenses as a percentage of revenue right now. Currently, it stands at about 17.5%, and the long-term trend is definitely going up. So the most recent $5 billion loan was issued via 2 different notes and a term loan, and I won't go into the details here, but the total interest cost is close to 7%. And while that's generally a good interest rate for a company with the credit rating of TransDigm, it's just objectively not a low interest rate loan. And that said, and this is why management makes this decision, and you kind of alluded to it beforehand, when you can deploy capital at rates of 20 to 30% and borrow at 7%, each dollar kept inside the business beyond what's needed to sustain the business and do acquisitions is earning a low incremental return. So in that case, it just makes sense, in theory, to lever up to a level that still feels safe and distribute that capital back to shareholders.
Well, I think at this point, anybody who's listened to this podcast a few times will know that we are big fans of buybacks, and objectively, they tend to be more tax efficient, right? You usually have to pay, there's this double taxation, right? The company pays income taxes on its earnings, and then they pay out some of those profits to you, where you have to pay an income tax on it. Whereas if you're doing buybacks, you're essentially pushing the stock price higher, but there isn't immediately a taxable component to it. And if you do ever sell, then it's at a capital gains rate, and typically capital gains rates tend to be lower than income tax rates. Point being, share buybacks are literally more shareholder friendly, typically. And so I suspect, though, that they can't really do more buybacks because the stock is trading at more than 40 times earnings. So you're just not getting good bang for your buck in terms of the intrinsic value creation from each dollar that goes toward repurchases. That's kind of the dilemma for TransDigm, it seems like.
It's similar to what Ferrari faced when they are just trading at 15 times earnings, at least when we did the episode, and their buybacks just don't move the needle. I mean, the best case would be for TransDigm to just find so many good acquisition targets that they can deploy all their capital buying those companies. But of course, given their pretty harsh criteria and return expectations, that's just not realistic. So I can understand their dividend policy, but still, as an investor, I would want to keep an eye on interest expenses and their development when all the debt matures over time and they have to refinance it. I mean, we talked about how TransDigm likes to use adjusted EBITDA as its key metric, and it also uses it to put debt into perspective. And they report a metric which is called net debt to adjusted EBITDA, which in my mind doesn't give you the full picture, since you are excluding interest payments, which are not only a real cost that you have to pay for. As I said, it's also the main problem that I have with the amount of debt. So I think you should at least also look at net debt to adjusted free cash flow, which is, as I said before, somewhere between 11 and 13, compared to TransDigm's reported net debt to adjusted EBITDA, which stands at 5.7 right now. And that's after the most recent debt issuance, and it's right in line with their 6 times target ratio. So again, they are pretty focused on not going above that range of like 5.5 to 6. So I like that they always keep being well in line with what they tell investors and shareholders. Another factor that usually makes debt a risk in this sector is the cyclical nature of aviation. I mean, Boeing and Airbus invest in cycles, and in a downturn, delivery volumes can easily drop as much as 50%. The good news, though, is that we are currently in an upcycle. So that will likely still last at least a number of years. I mean, in the past 60 years, cycles have consistently increased in duration, and the last one lasted about 15 years. So that would indicate, if you look at the charts that we currently have on the screen, at least another decade of growing deliveries from here. And of course, TransDigm's heavy exposure to the aftermarket further softens the impact of production swings, as well as, since those parts always need to be replaced, all of the deliveries they have.
However they're doing it, total shareholder returns just continue to compound at incredible rates, as they have over the long term. And that's just not totally surprising, because extra debt does add leverage to their financial results, which can enable accretive acquisitions or these special buybacks and dividends that juice results from total return perspective for shareholders. And not like we like to speculate on macroeconomics, but we are recording this at a period where the Federal Reserve has just cut interest rates 2 months in a row, and there's a consensus that they may do so again in December. So in terms of refinancing their debt, they may actually end up being lucky in the sense that they could have the chance to refinance even at lower interest rates. So that would be good for the short to intermediate term prospects of the business. And by replacing equity financing with debt, they are shielding themselves a bit from taxes to an extent, since interest is tax deductible, and therefore that reduces the after-tax cost of debt, because basically you're reporting a lower net income number because of those interest costs. And so again, from a kind of capital allocation perspective, I do think that helps explain some of the decisions here and how they are trying to create value. And for the most part, we've said it a bunch today, it just strikes me as a typical private equity strategy that's being played out in public markets. It seems like they have targets for how much net leverage they'd like to carry, and after completing acquisitions that can temporarily drain their cash balances, so they reload with more debt to keep themselves in a position basically to always be able to make more acquisitions, while also not taking on so much debt that they don't think they can sustain those debt servicing costs, the interest payments, with the underlying cash flows generated by the businesses. And if there aren't sufficiently attractive acquisition opportunities, rather than just letting that cash sit on the balance sheet, that's how I think you get this outcome where they kind of strategically pay out special dividends before then deciding to lever up again. And they'd rather do that opportunistically than commit to some recurring dividend payment that just makes them less financially nimble, right? You're bound to the structure of shareholders are expecting XYZ amount of cash from us every year. And that's just not the model that they operate under. It's such a different mindset from the compounders we usually look at. But I see why it works. And I think it's really interesting to study and learn about. And so bring it all together. Maybe this is folks' favorite part of the show or least favorite part of the show, but let's try to think about the valuation model and really what that says about the investment opportunity for us as we consider whether we'd like to add it into our very limited intrinsic value portfolio, right? We only have a handful of companies that we've actually covered on the show that we've then decided to invest in.
Well, TransDigm it's obviously a company that's still trading at a premium valuation, but that has been the case since its IPO, and the company simply is significantly better than the average company in the S&P 500. I don't think we have looked at any other company yet that has such a consistent outperformance and premium valuation as well. And in my model, revenue growth at about 10 to 11% a year, with defense sales outpacing commercial sales. And that's slightly below top line growth in the past 5 and 10 years, but it's mostly in line with the current outlook in the aerospace market and also analyst expectations. And in terms of adjusted EBITDA and the adjusted EBITDA margin expansion, and also the conversion of adjusted EBITDA to free cash flow, which is still something we want to look at, I keep it with the company's goals and also the historic averages. So an adjusted EBITDA margin expansion of 1% per year and a 50% conversion to free cash flow. Both have been consistently achieved in the past, and the conversion tends to be even slightly higher than the targeted 50%. And what makes TransDigm so difficult to model are these significant but inconsistent dividend payouts that we just talked about. I mean, in my model, I used what I would say is a very simplified approach, looking only at the historical ratio of dividends to adjusted EBITDA. So when a dividend of $1 billion was paid, how did that compare to the adjusted EBITDA in that year? It's not perfect, especially because these dividend payments, as we alluded to, are paid through debt anyway, but it is a proxy that works. And if you want to, you can model it much more complexly by using target levered ratios, the net debt to EBITDA metrics, and certain triggers that are activated when the net debt to EBITDA ratio goes below a certain threshold. Ultimately, though, it is still a guessing game. We could see 3 more special dividends till 2030, or none if they actually find enough acquisition targets. And honestly, I think that's what I would prefer for TransDigm and as a shareholder. And I think my main takeaway from the modeling exercise is that TransDigm is about fairly valued. Maybe you could argue that it's slightly overvalued if they can hit my growth assumptions, which are slightly below what they have achieved in the recent past. So I think it kind of balances out. And special dividends will basically be what determines whether shareholders can expect a high single digit to low double digit return or a return in the low or mid teens. And when I think about investing in TransDigm, I think it will make it less about the modeling exercise and more about whether I'm okay with the couple of concerns that we have raised in this episode and that have been raised generally with the company this year and to some extent also earlier. Are you, for example, just okay with owning a company that makes highly aggressive and also unpopular pricing decisions and takes on a lot of debt? And I would say most other factors in mind are rather short-term than long-term concerns. So these are the ones that I would focus on, because I do believe that TransDigm will not run out of potential acquisition targets anytime soon. And I don't think that the recently lower sales in the aftermarket segment are part of a longer lasting problem. And yeah, I mean, you talked about the easy test of asking myself whether I could sleep well at night when I own TransDigm. And honestly, the answer is probably I don't know. At the current valuation, there are so many things that are still kind of lingering over the company that could cause it to go a bit lower. I would say it's a good thing for me now that we do not have to make this decision on our own. So I can ask you, what's your take? I mean, could you get comfortable with it? What do you think about the debt and all of those factors?
It's funny because before we had this call, I think Daniel was expecting me to just like totally veto TransDigm. And I guess I surprised him a little bit because I guess I could be willing to get excited about it. If we can justify Berkshire Hathaway as an addition to the portfolio, I mean, I can just as easily see why we might want to add TransDigm. Both are these best in breed acquirers with really well-proven playbooks for success and just really some of the best management teams you could possibly imagine that are finding these, these kind of really niche businesses, or at least this is more of what Berkshire used to do, and just buying them because they're almost never going to go away. You don't know if the next hot software company is going to be here in a decade, but you're pretty sure that the industry leader in seat belts on commercial airline planes is still going to be there. They're not going anywhere. And so TransDigm's uses of capital do strike me for the business model they have as actually being very practical and as really being focused on lowering their weighted average cost of capital over time, which is sort of a theoretical concept that you might learn in a finance class, but it is real. I mean, this is another way of generating shareholder value. I mean, you can grow earnings and profits, but also if you can reduce your cost of financing, that is another way to create value. And so I'm not looking at their debt levels here and saying, okay, this is a company that is just recklessly raising debt because they can't self-sustain their operations. I think they're doing it very strategically to, fund their acquisitions and returning capital to shareholders when it makes sense to, all with this aim of truly generating more and more earnings per share or free cash flow per share. And so again, this is a stock that has almost literally never gone down. And I think you were joking before that it almost reminds you of the Bernie Madoff Ponzi scheme documentary on Netflix, where they say something along the lines of the fact that the returns never went down was an indication that there was something fraudulent going on, because it really does feel too good to be true, which is to say that not literally the stock has never gone down, but you have decades of showing that it just is such an incredible compounder. And so would I make this a 5 or 10% position in our portfolio without really digging into their capital allocation strategy more, or understand the competitors and regulatory risks they may be incurring by being so aggressive with taking pricing as working as a defense contractor? The short answer is no. But would I be willing to add this as what they call a tracking position? So essentially we get exposure to this, great business while also using that as a reason to continue to learn and better understand them as we go. So to me, I'm not looking at this saying, oh, it'd be terribly risky to add it at 2%. I'm saying we should probably have some exposure in it, so we have some skin in the game that motivates us to study the company more deeply, because this could be a really, really good investment. And if it ends up not being a good one, there doesn't seem to be much of a risk that the stock is going to dramatically go against us. And basically, we're just buying some more time to really better understand the investment. And a 1 to 2% position really is just kind of the gateway to that. But yeah, if we're not sleeping well at night because we buy this thing, we should sell it and maybe, I don't know, buy more Google.
I think there's actually truth to the saying that you must own a stock to fully understand it and to kind of keep learning about it. And I must admit, I am surprised to hear that you would actually be willing to open a position here. On the other hand, if one of us gets scared by higher multiples, it's probably me. So looking at it, seeing it at a P of 40, it does scare me a little bit. But then again, you look at the chart, you see where it traded in the past, and then you have to admit that they've done a phenomenal job for 30 years in a row. And there's not much that could seem like, first of all, a terminal value risk, and also just a reason for this not to go on. And yeah, I think a startup position is very reasonable, considering the quality of the company and also the downward trend that we have seen this year. And if we can get a better price in the next couple of months, we can double down. And otherwise, we just, keep learning more through owning the business. And we might get more comfortable with the company, even at these prices or at higher prices, to then double down and, leverage it up to, let's say, a 5% position. So it does sound to me like you agree on making this, let's say, a startup position at, let's say, 2% for now.
Yeah, let's do it. I don't have any issue with it. I'd be excited, genuinely, to have, this company in the portfolio and to have a reason to learn more about it. And, we mentioned this a little bit already, but this is the epitome of why we love having the intrinsic value community that we host, and why we invite everybody who listens to this podcast or reads the newsletter to consider applying to join it. It is a selective group. We can't bring everybody into it, but really the point is to have this kind of mastermind where we can in real time give feedback on ideas, have people point out our blind spots, and support each other in the investment research process. And so, yeah, I think we're going to set up a call on TransDigm and speak to, 10, 20, 30 of our, really trusted friends who we've met through the podcast, who are thoughtful, sophisticated investors who can give us their perspective and help us better understand maybe what we don't even know, what we don't know about TransDigm. So yeah, I'm excited. I think this is going to be fun. This is kind of a new area for us to dig into, and obviously a great business. So it would be really hard for me to protest it, even at a premium valuation. If there's ever a time to pay a 30% premium to the S&P 500, by gosh, it might just be TransDigm.
Okay, well, then for now, let's say welcome to the new position holding in our intrinsic value portfolio, which is TransDigm, even though it's a startup position yet. And as you said, I think I look very much forward to the call we will have on this stock, because especially when it's about industries that neither of us are really, looking at every single week, we have people who are working there. You just get so much more value from talking to those people and getting basically insights into the industry. So yeah, I'm looking forward to the call, and also to our next episode, which is next week and will be by you. So I'm curious to hear, what are your hints for the next company that we will pitch here on the show?
On to the next. Yep, we cover a different company every week. We go pretty deep on them. It is a challenge, but it's also a ton of fun. So my hints this time will really be for those who have tracked our intrinsic value portfolio the most, either from listening to the show or from actually reading our free newsletter that gives recaps of basically the podcast and shows our portfolio in real time and how it fluctuates from week to week. And of course, if you're interested in that, you can go to theinvestorspodcast.com. Sorry for all the promotions, but it is true. I think a lot of people who listen to this don't know that and would really enjoy reading the newsletter. So yeah, my pitch for next week is a company that is effectively the biggest and most direct competitor for one of the largest portfolio holdings in our portfolio. It may be the largest depending on how prices fluctuate from week to week, but definitely tied for really being first place. And they also pulled off maybe the greatest acquisition ever 20 years or so ago that led to the whole company being rebranded. And as a last hint, if you're an American, you probably are more familiar with their subsidiary brands. You've probably used them, whereas Europeans will know the actual kind of parent company itself and have probably used its products and services before. I don't know how to say anything else without giving too much away. So that's where I'll leave it.
I think it's fine. I think, dedicated listeners of our show will have an idea of what company you could be talking about. All right, as always, let me close it with a quote today. And I know I already quoted Nick Howley today once or twice, but I think his special take on running a business is worth at least another quote. So I'll go for it. Howley said, quote, "The decentralization was almost a religious belief. If you want people to act like owners, you have to treat them like owners and pay them like owners and give them a fair amount of autonomy." And I think TransDigm got what it incentivized for, as I said before, and it made a lot of investors a whole lot of money. And I think and hope it will keep doing that because we're invested now. And I will soon look at a company that is on a similar trajectory, but it's at very early stages. So pretty sure that one will be interesting as well. And for now, have a great day, and we will see you next week.
What S&P Global is to US markets through the S&P 500 is like what MSCI is to international equities. Their indexes are the most common way to categorize, benchmark, and describe the performance of stocks all over the world.
They really benefit from this network effect where ETFs and mutual funds need to benchmark against appropriate indexes. And when companies like MSCI and S&P have by far the most recognizable names in this business, that's just a huge advantage to have. As the world becomes more financialized and as passive investing continues to eat financial markets, MSCI just continues winning.
It's really as good of a toll road business as any out there, like VeriSign, Moody's, and FICO. MSCI's dominance over indexes make the company nothing other than a high-quality compounder.